Thank you so much for joining us this evening on the webinar, and we apologize for the delay. Without much ado, we will get straight into the webinar. Over the past month or month and a half, one particular event has been plaguing the markets across the world. It's not just equity markets, but including the commodity, the foreign exchange markets, and trade in general across the world. And this is the potential trade war that the President of the United States, Donald Trump, is proposing to introduce across the world. We will be looking at the world economy and some particular implications of this decision of Donald Trump on how it affects some of the economies across the world in this edition of the webinar. To begin with, we will be looking at the global economy, then we will be looking at the Indian economy, and we will finally be arriving at the investment strategy. Let's look at the economy of the United Kingdom and European Union. In the last edition of the webinar, we discussed the GDP of each of these economies, and most of them had shown a positive growth. However, there is also a slowdown in the pace with which the growth has been seen across the world economies. But when we look at measures such as PMI, which are an indicator of how the economy is performing on a monthly basis, it still seems to suggest positive growth. Manufacturing PMI stood at 58.6 for the month of February for the European Union. That's dropped to 56.6. A reading of over 50 means that the economy is performing really, really well. But the pace with which the economy has grown in March is slower compared to February. The biggest concern for the European Union is the inflation. Across the developed world, including US, UK, European Union, Japan, the ideal inflation is about 2%. But if you look at the European Union's inflation, it stands at 1.6% for January and fell to 1.3% in Feb. One of the biggest contributors for this fall. So as we were discussing, the inflation of the developed economies of UK, US, Japan all need to be at about 2%. And the inflation for European Union has been particularly weak. It's been about 1.6% in January and 1.3% in February. Now, one of the prime reasons for this fall is something that we will be discussing in the subsequent section. And this happens to be oil. Because the European Union is one of the bigger importers of oil, and if oil prices go up, so does the inflation of the European Union. But the oil prices compared to in February compared to Jan were actually lower, which is possibly one of the reasons why the inflation for the month of Feb is actually lower compared to the inflation growth for the month of January. But if you look at the other factors, such as the unemployment rate, the unemployment rate of 7.1% is lower than 7.2, which was read in January. And this in itself is actually a big achievement. Now, the European Union is currently living under a very cheap credit economy. The European Central Bank is buying bonds at an incredible rate, which it's trying to taper off by the end of this year. However, with indicators such as this, it may seem that the European Central Bank may have to extend its bond purchase program. There are other factors that are also affecting the growth of EU and the UK. And these will also have sort of an impact on India. Thank you. And as we were, so there are a couple of events that are happening in the European Union which could potentially affect India in a seemingly indirect way. One of them is the results of the Italian elections. Italy had elections in March, and as of last week, the Eurosceptic parties had agreed on a coalition to lead the Italian government. Now, the problem with a Eurosceptic government in Italy is that Italy is the third largest economy in the European Union. And when they get Eurosceptic, what we will be having is a second version of Brexit. In this case, it will be sort of an Italian exit. That is, if they have enough of, if they have enough popular support for this particular move. The other factor that could affect the that could affect the European Union is the growing tensions between Greece and Turkey. Greece and Turkey are seeing escalating tensions between, and there have been exchanges of even crossfire, which could potentially also lead into an armed conflict. Now, why these two will affect the Indian economy potentially is because India is part of the globalized economy, and if Italy exits the European Union, euro will weaken, gold will become stronger, and with the weakening of the European Union due to the exit of the Italian due to the exit of Italy, what we could also see is the subdued business between India and the European Union. Now, this is more the reflection of the result of the Italian elections is actually a reflection of how growing protectionism is affecting across the world. And the United States is one of the biggest culprits at the moment for perpetuating the protectionism, especially with the President Donald Trump. So, as we had said in the earlier of this webinar, Donald Trump had proposed to sort of trigger a trade war when he introduced tariffs on imported steel and imported aluminium in the previous month. Now, this was primarily targeted with the intention of reducing the trade deficit that the United States has. Now, this was met with a lot of criticism during its introduction, and so Donald Trump had temporarily suspended these tariffs for the allies of the United States, specifically like the European Union, Japan, and South Korea. But the tariffs were still continued to be levied on exports from China. Now, with the extension of in addition to the extension of these tariffs, Donald Trump has proposed a taxation to the tune of $50 billion for imports from China. And this has not gone well with the Chinese government, and they have proposed to slap a reciprocal $50 billion. So what this essentially means is the trade between US and China could actually deteriorate. And that is a problem once again for us, because the world's largest economy is the United States. The world's second largest economy is China. And how the world economy currently runs is that China manufactures and sells to the United States. And the United States is one of the biggest consumers in the world. And when they start to weaken, it means India's ability to export to the United States also weakens. This trade war also has some more implications, which we'll be discussing in the subsequent sections. But when we look at the US economy, as measured by the PMI, it seems that the US economy is still robust. Services has seen a marginal decline in growth in March compared to February, but it is still a robust growth nonetheless. The inflation, the core inflation for the month of March stood at 2.1%, and compared to February, which stood at 1.83%. Now, considering all of these factors, the US Federal Reserve, in its last policy meet, had raised the interest rates by 25 basis points, as was expected. And this led to a correction in the stock markets across the world, while it also added to the strengthening of the US dollar. So, as we had discussed for the EU, uh, an inflation of 2% is actually it's where ideally the inflation should be for the developed economies such as the United States. So, a 2.1% core inflation all the more contributed to the Federal Reserve's decision for raising the interest rates. So the benchmark now has been raised from 1.5% to 1.75%, and this is the sixth time that the U.S. Federal Reserve has been raising interest rates since December 2015. Considering how it's over just a period of slightly under 2.5 years, it's seen quite a rapid increase in the in inflation rates, which means that the Federal Reserve sees the U.S. economy strengthening. But all of this could still be subjected to the decisions taken by the President of the United States. If Donald Trump does go through with his trade war rhetoric, it means that the U.S. economy will actually might actually weaken. Now, looking at the economy of Japan, the Japanese economy reached a sort of a landmark of sorts in the previous month. Uh, Looking at the readings of the core inflation, it was for the first time that the inflation in Japan reached the 1% mark in 3.5 years. And like the EU and like the US, it too is targeting 2% inflation, which historically has been the biggest problem plaguing the Japanese economy for over 2 decades. Wage growth has also seen an increase for the same period, with a growth of 1.2% in January to 1.3% in Feb. And surprisingly, unemployment rate actually increased by about 0.1%. And this is for the first time that the unemployment rate has increased in 9 months. But if you look at the other factors uh, measured by the PMI, it still suggests growth. The services have expanded, manufacturing activities expanding. Overall, the economy of Japan is still it's still on the path of growth. But one of the problems with the trade war was uh, during such a time, investors across the world look to invest in safe havens. Safe havens include the US dollar, gold, or unfortunately for Japan, the Japanese yen. Because the Japanese yen is considered a safe haven, and with the threat of trade war, there was increased investment in the Japanese yen. So what happened was the Japanese yen actually strengthened over the past couple of months. Why this is a problem is that Japan is quite export dependent, and if the yen strengthens, it means that the ability of Japan to export actually weakens. So it is no surprise that the services as well as the manufacturing activity had declined in March compared to February, primarily due to the strengthening of the yen, that in turn weakened its exports. Looking at the neighborhood, specifically China and Asia Pacific region, China is not exactly backing out from the trade war that was initiated by Donald Trump. What China did was to propose a $50 billion tariffs for importing U.S. goods in reciprocation to U.S.'s decision to impose $50 billion in tariffs for Chinese imports. Now, this was not a reaction that President Trump had expected. So now he considered raising another $100 billion of the another $100 billion in trade tariffs with China. Now, the U.S. and the Chinese economy have about $500 billion trade relationship. China exports about $400 billion to the US per annum, and US exports about $100 billion of goods and services to China. Now, with the imposition of tariffs, this huge trade could actually be affected. And if that happens, the whole world catches a cold. So, as can be seen in the PMI numbers as seen for China for the month of February, the activity for services as well as manufacturing in China has declined. The manufacturing activity has declined marginally, but the services has declined quite drastically. And this in turn is having an effect on the composite PMI of China. So in this quarter, we can actually expect the Chinese economy to not grow as fast as it had in the previous quarter, where it grew by 6.8%. And this primarily will be due to the trade war. Now, there is another risk which China also did consider due to the trade war. This was to offshore, to offload some of its holding in the U.S. government debt. The Chinese economy is the largest holder of U.S. government debt, which means that which means China holds close to more than $1 trillion of debt of the U.S. debt. And if China decides to offload some of this, this could mean a crash in the value of the dollar and an overall weakening of the U.S. economy as a whole. And this in turn will have a ripple effect and cause a worldwide recession. But fortunately, over the past week or so, the threat of the trade war has actually weakened. With in a recent interview, Donald Trump had sort of said he would not be proceeding with the Cold War, or even if it is a Cold War, it's something that the US has already lost, blaming it on its previous presidents. Now, these factors in turn led to a somewhat stabilizing of the world economy, which brings us to the next uh, uh, country of most important to us, of most importance to us. With the weakening of the trade war, what happens is uh, in order to give you sort of a context, because of a trade war, what could potentially happen is consumption activity will go down, and if consumption goes down, the demand for some of the resources will also go down. Specifically, in this case, it would be oil. With the oil prices having gone down in February, uh, as can be seen on the left side, the inflation of India, as measured by both CPI as well as WPI, actually went down in February compared to January. But with the potential threat of trade war actually waning out, what happens is the expected demand for oil will actually go up, which in turn means that the prices of oil across the world will actually rise, and that is currently the situation where we are in right now. Oil is the biggest. It is one of the biggest imports of India, because India can only produce up to about 20% of its oil requirements. It imports more than 80%, and so oil is a sizable part of India's import basket. With the oil prices picking up now, we can actually expect the inflation to pick up further in the months of March and April. But looking at the other factors, such as mainly measured by the PMI, we saw that the services had declined unexpectedly in the previous month. But it is seen picking up once again in March, but although at a very marginal rate. A reading of 50 in the services means a growth in the economy. A reading much greater than 50 means a very strong growth in the economy. And as can be seen on the right side, Services PMI has had PMI reading of 50.3 for the month of March. And this means that not all is not well with the services sector right now. So we can still expect some bit of turbulence in at least for a short bit of time. Now, looking at the PMI numbers, it also gives an indication of how the economy of India performed in the previous quarter. There was a contracting in activity in services in the month of February. So the Indian GDP may not grow as fast as we would not have grown as fast as we would have expected it to grow because of this particular factor. While we may know that the actual growth rate only after the official release of the statistics, we expect that the Indian economy would have grown by about 7%, which is slightly lower than what the pace with which it had grown in the previous quarter, where it grew by 7.2%. Now, in its last policy meeting, the RBI had decided to maintain status quo, and it decided to maintain interest rates as it is. The primary factor for RBI taking such a decision is the inflation. The RBI would like the inflation to be at 4%, plus or minus 2%. Now, as can be seen left side of the screen, both the CPI as well as WPI have been very much within the 2 to 6% range, where the RBI would like it to be. So it is comfortable with keeping the interest rates as it is. Now, when the RBI does not raise interest rates, what happens is when the RBI does not lower interest rates, and if it raises it or if it keeps it as status quo, one of the implications of this is the weakening of the Indian government bond rate. So over the past 6 or 7 months, we've actually seen that the Indian sovereign bond had actually declined in performance, and we had seen the yields had gone up, but the prices had gone down. But something happened over the past month, and this in turn rallied the Indian bond market quite significantly. And this was regarding the government's decision or regarding how it will be going about financing its budget for the current financial year. The government of India said that it would borrow up to only 48% of its. It will go with only 14% of its planned annual bond sales in the first half. Typically, the government goes to about 60 to 65%. The government is also pumping more of money market and short-term bonds. This is actually a boon for the Indian bond market. The total borrowing from the market was also cut down by 50,000 crore. So all of these mean that the demand, the availability of long-term bonds in the market actually declined, and that is exactly what we will be discussing in the subsequent slides. But right now, we'll have a quick look at the oil and the gold prices. Earlier, when we had discussed the US as well as the Chinese potential trade war, it can actually be the story can be seen in this particular graph. So between 12th to 26th February, you can see that the crude oil prices had been rising, and this was primarily due to the reports of strengthening with the the Russia and the OPEC agreeing to extend production cuts. But there were also reports of the US government, there were also reports of increased production of oil from the non-OPEC members, such as the US and Norway. So that meant that the effects of OPEC to reduce the supply in the market actually was was limited. So between the end of February and mid of March, oil prices more or less were stable. But it is afterwards that you would actually see that uh, there's a sharp rise in the price of oil, and this happens due to the trade war. The trade war had quite mixed effects across the world economy, and when US itself goes into a trade war, it means that too with the second largest economy, it means that the US is potentially it stands to the US dollar actually weakens a little bit. Now the US dollar and commodities generally have an inverse relationship. As the US dollar weakened 19th March to till the last week of March, you can see that the oil prices actually rose very sharply during that time, hitting a peak of $66 a barrel. And gradually, what happened was there was a slight difference in the stance that the world had taken. At this point, the world had assumed that if there is going to be a trade war, that means the consumption activity is going to go down. And if that goes down, the demand for oil also will go down. And this in turn led the oil prices to actually decline. Now, with the threat of the trade war, not with the President Trump saying that he may not escalate the trade war any further, the demand for oil once again went up. So, as you can see in the last week of mentioned in the graph, there's a sharp rise. So there is going to be a lot of volatility in the oil markets, and a lot of it will depend on more of macro factors. And there's very limited things that we as Indians can do to keep the fuel prices in control. It's a similar story with gold as well. So as you had seen in the previous graph, between 19th and 26th March, there's a sharp rise, and this is because of the strengthening of the it's because of the weakening of the US dollar due to the comments made by Donald Trump. But other indicators within the US economy itself, such as the improved payroll data and the strong inflation, meant that the dollar was actually strengthening. So gold has been volatile, but has also been playing within a certain range for the past 3 months. Now, over the past few months, we have had uh, customer requests regarding explanation for how we select our portfolio and why our portfolio has not exactly like performed well over the past 6 months or so. And we will be addressing in that in the next couple of slides. And we will also be using some of what we mentioned previously as to show that your portfolio is still safe and and macroeconomics will temporarily keep your portfolio from rallying, but it is good for the long term. So this is a graph of the long-term audit portfolio, which is the most commonly recommended, which is most uh, it's the most popular portfolio that is among our customers. Now, as you can see, the long-term bond rate over a period of 7 years will actually give you a CAGR of at least 1% compared to the benchmark. Now, this benchmark consists of both equity as well as bonds. Now, if you look at the equity, if you look at the benchmark as well, for the period of December 2017 till date, you can see that there is a sharp decline. Now, coming to the specific funds that are in the portfolio, which we have also received complaints, which we have requested, which for which we have requested, for which we have received requests on as such. We will be discussing two particular funds which have seen sharp decline over the past 6 months or so. This primarily has a lot to do with the macroeconomics and a little bit with the fund management in itself, and we will be addressing both of them in the subsequent slides. We'll start with the mid-cap fund which you currently recommend to the customers. This is Motilal Oswal Mid-Cap 30. The graph on the left side shows how the mid-cap index has performed, and this is taking the Nifty mid-cap 100 as a reference versus how Motilal Oswal mid-cap fund has performed. On the left side, it is quite obvious that Motilal Oswal has not performed well. It has more or less remained flat for a period of 1 year. And yes, we have been monitoring this, and there is a particular reason why we did not go ahead and change this fund. See, when we recommend a fund such as a mid cap, it is actually meant for a long term. A period of about 6 months or 4 months or even 1 year for that matter is not particularly a good enough measure to tell how long or how good a fund is. So just to give you sort of a snapshot of how Motilal Oswal has performed over the past 4 months. So this is after discussions we had with the fund manager itself, and so there were a couple of minor changes in the portfolio which were introduced in towards the end of December, and that impact can be seen in the from January. To the right side of the screen, you would see how Nifty Midcap has performed against Motilal Oswal. While it did initially rally much higher, it also fell much sharper than the Motilal Oswal as well. And Motilal Oswal's mid-cap fund has recovered its losses at a much faster rate compared to Nifty Midcap. And this has a lot to do with the stock selection that the Motilal Oswal had changed in their portfolio over the past few months. Overall, we are still very bullish on Motilal Oswal because of the very strong fundamentals that they maintain in their fund management. While there is volatility in the global markets, it will also reflect on how it will also have an impact on how your funds will perform. But in terms of the amount of risk that the fund which we are recommended is giving you, it is significantly much lower compared to the benchmark. The other fund we will be looking at, which has crashed over the past 6 months or so, is IDFC Government Securities Provident Fund. So, as we had discussed in the previous section under India, we had discussed about how the RBI not lowering its interest rates is actually a problem for long-term government bonds. So, as can be seen out here, while there is a rally from until the month of September, since then the bond market has been crashing, and in all our portfolios, we do recommend bonds due to the stabilizing factor it gives to the portfolio, as well as a long-term rally it provides. Now, there is a lot more of event-related fluctuations that happened in the funds which we recommend, but overall, we are quite bullish on the funds which we recommend because the macro story of India still remains the same. There will be volatility, but in the long term, we will see strong and stable growth. Now, considering these, we will be looking at what should be the investment strategy, and which is typically how we would recommend a portfolio to our clients as well. We typically recommend long-term views of our portfolio, because in the short term there will always be volatility, as can be seen in the equity markets, which had rallied to a peak at the end of January but have been in a free fall since then. It's not just the equity markets but bond markets as well. But typically we would, but typically just holding on to a fund is actually much more beneficial than exiting the market and timing it during its return to the bull run. So, looking at the world economic events as well as the Indian economic events, there will continue to be volatility in the equity markets. There will continue to be uncertainty due to policies coming from the United States, and the RBI not lowering its interest rates, oh, even which we expect even in the next policy review, will keep the equity markets volatile. But there is a lot of investment activity that's picking up in India, and the decline in private investments has seen becoming uh, it's seen bottoming now, and so we expect private investments also to be picking up in this current financial year onwards. So with the increased investments from both government as well as the private sector, we can actually expect the uh, Indian equity markets to rally and the Indian economy as such to become stronger in the coming quarters. So, in order to tide over the exit volatility, it will be much better to invest in the form of an SIP. Or if you already are holding equities, it is best to stay invested and wait for the bear market to pass because the bull is not too far away. Bonds will, as we had seen in the previous graph, it has seen an increase. Now, with the government uh, reducing its borrowing, the availability of bonds actually decreases in the bond market, which means that the prices of bonds will increase, and increased prices of bonds is positive for the overall bond market. So bonds will continue to rally at least for the next 6 months for sure, because of the reduced supply. So it will therefore be useful to have bonds of medium to long duration in your portfolio. And volatility will continue to persist in the market. And whenever there's volatility, gold will continue to shine. And volatility will continue due to the uncertainty emerging mainly from the European Union, as we have discussed, the Italian elections, the Greek-Turkey relations, uh, and more policy uncertainty possibly coming from the United States. So it will be good to keep gold as a hedge because it will help you stop. It will help you minimize your losses in the portfolio that will come due to the volatility in the equity markets. With this, we reach the end of our webinar. Thank you so much for your participation. We'll now be answering your questions. We do have a question regarding the portfolios. It's about if there will be any portfolio shuffling that will be expected from our end. As of now, we are actually reviewing our portfolios, and we do see a few funds where we can exit from, and we are in the process of finding replacement funds, and this primarily is due to recent circulation by SEBI regarding the mandate of the fund about the fund quality and the fund motive. So considering these, we are actually looking at a few funds which could potentially change in the next month or month and a half, and we will be in touch with you whenever we do initiate a fund change. But with regard to the allocation of the portfolio, we are actually quite comfortable with where things are because even with the hybrid benchmark or consisting of both bonds and equity, our funds have quite outperformed with the given allocation. But with regards to specific funds, we are looking at a few. We are reviewing funds, and if there are any changes that we will that we feel is absolutely necessary, we will definitely be in touch with you in that regard. Right. Okay. I understand that your portfolio has about 60% equity and 40% bond, and yeah, I think that would pretty much be the allocation that we will be looking at also in the coming going forward as well. Because I believe that you would have a long-term moderate portfolio. So I will just have you just to kind of present the same graph which we had discussed earlier. This is what the long-term moderate benchmark looks like, and So there have been down times in the market as well, and despite the downtimes, you can actually see that our the allocation which we have recommended to you actually performs. The losses that you incur in the down market is actually much lower compared to the losses which you would make in the up market. Sorry, compared to how much losses you would make against the benchmark. So essentially, the 40-60 ratio, which we have kept now, is actually meant for your long-term growth. Uh, there will be temporary blips due to events, as we can see in the graph over here. Like for example, in towards the end of 2015 and early 2016, there was literally no growth. But if you look at the benchmark, there was actually a slight correction. The allocation which we have given to you right now will ensure that your losses are minimized. At the same time, whenever there's a bull market, you will stand to gain from it. So going forward, we do not see much of a change in the allocation. So much for participating in today's webinar. We hope to serve you and see you in the next webinar as well. Thank you so much for your participation. We will be sharing the recording of this webinar with you shortly. Thank you.